This is Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. Welcome to the weekly top three, the top three things on our mind here at Alaskans for Sustainable Budgets for the week of June 8th, 2026. The weekly top three is a regular segment on The Michael Dukes Show. The show broadcasts on both Facebook Live and YouTube Live, as well as via streaming audio from the show's website, weekdays from 6 to 8 a.m. I join Michael weekly in the first hour of Tuesday's show from 6:10 to 7 a.m. for a discussion between the two of us about our three issues. We post the podcast of our discussion following the show on the Alaskans for Sustainable Budgets Facebook, YouTube, SoundCloud, Spotify, and Substack pages, also on the Alaskans for Sustainable Budgets website, as well as the project's page on national blog site, medium.com. You can find past episodes of the weekly top three also at the same locations. Keep in mind that in addition to these podcasts, during the week, you can also follow and participate in the discussion with us of these and other issues affecting Alaska's fiscal and economic condition by following us on the Alaskans for Sustainable Budgets Facebook page and through our posts on Twitter. This week, our top three issues are these. First, we asked the question, while we learned a lot this past week about the Alaska LNG project, is it really enough to demonstrate it's a good deal? Second, we discussed what the lack of interest in the ANWR lease sale last week tells us about the North Slope oil situation. And third, we explained why we think most, if not all, of the candidates for governor seem oblivious to the signals Alaska consumers are sending about their economic situation. And now, let's join Michael.
So let's get started. Number one of the weekly top three. We learned a lot last week about AK LNG, but is it enough to get it over the line? That's your question today, and I'm interested to see what you have to say about it.
Well, last week, last week was a data-rich week in the LNG hearings. Glenn Farn finally was more forthcoming, although still within a range, but they were more forthcoming about the potential, the likely construction costs. And we got a little bit more grounded with respect, a lot more grounded with respect to those potential construction costs than we had been before. Some are still doubting what NSTAR said about those construction costs, and it hasn't been constructed, so there's a legitimate basis for doubting it. But nevertheless, we got at least some narrowing of the construction costs that Glenn Farn's talking about, and we also got some additional insight into the negotiations between Glenn Farn and NSTAR about what's called the Phase 1 gas contract. Now, the way the LNG project has been set up these last few years is in two phases. Phase 1 is the construction of the pipeline down to the Matsu, where it would interconnect with the NSTAR system and use that as a feeder pipe into the South Central gas supply. That's Phase 1, just the pipe itself from the North Slope down to the Matsu. And then Phase 2 is the addition of the additional kit, or is the construction of the additional kit that's necessary for the export line. One is a big processing plant, or a big purification plant up on the North Slope to handle the additional supplies of gas that would be necessary, the additional sources of gas that would be necessary for the export volumes, and then the construction of the liquefaction plant itself down on the Kenai, and then the construction of a pipeline from the Matsu down over to the Kenai to support the export lines, the export volumes. So that's how it's been divided. And we got some insight into one of the big issues has been, what's that Phase 1 price look like? Because there are very little volumes going through a very big pipe in Phase 1, and the concern has been what the price of those volumes are. So we got some additional insight into that in the course of the discussions. Right. And so we know more than we did last week. But the question in my mind, is it still good enough? Over the weekend, I tried to think of how I could formulate some graph that gave us some better understanding of what's going on here. And I've got two graphs that I put in a column on my Substack page yesterday. I discussed one of them sort of in the Friday landmine column, but then over the weekend I spent more time on them and came up with two. And I want to talk about those for a second. Okay, so this is the phase one rate, and this is the most difficult, the most problematic of the issues. This is the rate that would apply just to the volumes that are going in state before the export facilities are built. And as you can see, well, there's three lines on here. The red line is what's called the JKM price, which is the Asian LNG spot market price. The blue line at the top is what NSTAR and Glenfarne talked about, the fixed price, talked about the price for phase one that they've agreed to, which is a fixed price escalated for inflation, fixed price beginning in 2029 when phase one volumes would begin to be delivered and escalated for inflation. And then the green line in the middle is an attempt at calculating what long-term contracts in the Asian Pacific the LNG market look like. Basically, what those contracts do, what the Japanese and the Koreans have done over time, the Taiwanese have done over time, is develop an oil indexed price based upon, to some degree, based upon the BTU value in a MCF of gas versus the BTU value in a barrel of oil, a fraction of the oil price that reflects the energy equivalence of an MCF of gas. But it's a price that's developed over time, price approach that's developed over time, that's been used extensively historically in the Japanese and the Korean markets for LNG. So I've used these prices, the JKM price and the historic pricing model used in the Asian Pacific market LNG as the proxies for what the price of LNG delivered to South Central would look like. The phase one, we're running short of cook inlet supply, so we need one of two things. We either need LNG supplies into South Central to supplement the remaining cook inlet supplies, or we need the line down from the slope. And this is an effort to look at the competitive position of those two. What you see is that, and I would say also that the red line and the green line, the two Asian Pacific LNG prices, have been adjusted to reflect the costs of the additional kit that NSTAR says it will need to receive import volume. So there's a $5 additional charge on top of what the landed LNG would look like, price for the landed LNG would look like on top, to account for the additional kit that NSTAR says it will need to build to receive the LNG and bring it into its system. So what you see here is an interesting thing. Because of the Iran war, global LNG, particularly spot prices, are currently elevated. I mean, we've had Qatar being taken out as a source of supply. Spot prices are in big demand. The spot price of LNG, the red line, the JKM price, has escalated as a result of that. So has the oil price, although not to the same extent, because the way the Japanese have done the oil index, it doesn't fully reflect increases in oil prices, doesn't also fully reflect drops in oil prices. But it's been elevated somewhat. The green line, the long-term price, has been elevated somewhat to reflect the Iran war. But what you see over time, and I went into this in much greater depth in the Friday column, in the last week's Friday column in the landmine. What you see over time is the JKM price coming down hard. Once the Iran war is over and Qatar is exporting again, the expectation is we go back to the situation that we anticipated before the Iran war occurred, which is a huge amount of LNG coming into the market, driving the price of LNG down. And so you see the JKM price, the red line, going down rapidly as the Iran war is over and as the additional supplies, long-term supplies of LNG come online. The green line, the oil price index line, is also trending down as the expectation is when the Iran war is over that oil prices will go back to something approaching the situation they were in before the Iran war, which is a moderate price as opposed to the elevated price that we've had as a result of the Iran war. Not diving down, but trending down over time. So you see that in the current situation with the Iran war, the fixed price that NSTAR and Glenfarne are talking about is a pretty good price compared to the elevated prices that we've got in the Iran war. But as the effects of the Iran war wear off, and particularly as the anticipated JKM price goes down, you see that the blue line at the top, you see that blue line persistently getting out of touch with the potential LNG, the prices for potential LNG supplies coming into South Central. What that means is we should have a very serious concern about this phase one fixed price that NSTAR and Glenfarne have entered into. You can see that price increasingly may get out of touch with the market over time if we're stuck in that price.
Yeah, and just for folks who are listening on the radio, at the end of this chart out at 2035, the three lines, JKM prices at $10.98, the oil prices are at $14 and $14.50, and the blue line, which is the fixed price as it trends upward with inflation, $18.56. So it's nearly double what Brad is predicting the JKM price would potentially be when the Iran thing is over and everything else. So you've got quite a wide spread at the very end, an $8 difference essentially at MCF price. For those of you who are on the radio can't see the chart.
Yeah, so it puts the Alaska in-state, if we're stuck in phase one, puts the Alaska in-state market at an increasing economic disadvantage. Alaskans at an increasing economic disadvantage as we're stuck on that fixed price escalator for the phase one prices as the free market supply prices for JKM and the oil market fall. Now The question is, are we going to be stuck in phase one? And that's what the second chart is an attempt to look at. The second chart is an attempt to look at if Glenfarne builds phase two, what's the economics of that going to look like? And again, we've got the JKM price, which is the red line, and we've got the long-term oil index line into the Pacific Rim markets in green there. And the blue line, which you see beginning in 2033, 2034, 2035, is that blue line is what the phase two, the full volume price looks like into the export market when we get to that point. And this is based upon that the blue line is now based upon the expectations, the midpoint of the range that Glenfarne gave for the potential costs of constructing the full kit, the full phase two kit, the phase two kit, the full export volumes, and the potential costs of that, taking it from a number of sources. It's an approximation, not perfect, but it sort of gets you in the range. And what you can see is at the construction cost that Glenfarne is now talking about, at full volumes, the phase one price, phase two price for the export volumes is higher than JKM, higher than the spot price, but lower than the oil index price. So it means that potentially, although there's a lot of factors involved here, but potentially the phase two price, the export price that Glenfarne's coming up with, is going to be sort of at the margin of potentially competitive into the Pacific market. Not super competitive, but not so totally out of the market that it's ridiculous to even think about it. So you've got the potential that if the construction costs come in around where Glenfarne's now talking about them coming in, that there's no price escalation, you've got the potential that phase two may work. If phase two works, the in-state price dives considerably, and Alaska has a great deal in terms of gas prices, because the volume increase of the phase two volumes drive the in-state price down to about $5 or $6 or somewhere in that range, considerably below where the phase one price is. If these phase two volumes don't come in, though, and Alaska is stuck in phase one, then you see the Alaska price escalating and really making Alaska much less competitive, much less competitive in terms of the in-state price than where it's going with imported LNG. So the real question here that all this creates, the real question is phase two going to go? If phase two doesn't go, then the phase one price escalates out of market considerably. If phase two does go, then the in-state price is good. I think, so that it comes down to this question: do you agree to the phase one price before you know phase two is going to go? And I think the answer to that is no, you don't, because the risk is too great that we get stuck in phase one, that Alaska gets stuck in phase one and has to pay prices that are considerably out of market for its in-state gas supplies. But that's sort of where the debate is starting to come down to.
Right. And so to simplify it, the price looks good now based on the elevated Iranian prices, or what the Iranian war has done to worldwide prices on natural gas and et cetera. The price looks good now. But once the effects of the war go away, which we assume is going to happen in that 5-year period, then it doesn't get, then it's not, then it would be more affordable to bring in import LNG than having our own line. But again, if we start looking at we're out of time here, but that 30, if it's a 30-year mark, what does it look like in 30 years?
Oh, the in-state, if we're stuck in phase one, the 30-year mark is horrible. I mean, we're way the heck out of market at that point. And we've essentially gone into something that's put Alaska at substantial disadvantage from an energy cost price 30 years out. If phase two goes, if the export volumes go 30 years out, we look really good.
Can we depend on imported gas is Terry's question. And I've seen that question from several people when I first started talking about it as an option, because nobody wanted to talk about imported gas. And we even had some of the diehard Republicans go, oh, well, they could just cut us off at the knees and we'd be without gas, and nobody. And again, I mean, we've seen enemies sell gas to each other, and the only time they ever shut it off was when there was a war going on. So hypothetically, I suppose it could happen, but especially if we ended up getting gas from somewhere in the United States or from Kitimat or someplace else, I mean, yeah, we're going to get gas. I think we can depend on it, Brad.
Well, yeah, the international gas market is becoming a lot like the international oil market. We're developing multiple sources of supply at multiple points around the globe. We're finding additional supply sources, gas sources that the LNG projects are being proposed to take advantage of around the globe. So it's becoming a lot more, the LNG market is becoming a lot more like the oil market. I mean, it's almost to the point, we're getting to the point where, the West Coast in particular, the West Coast of the United States depends on imported oil and depends on imported products. And we're fine with that. We're living with that because there's multiple sources throughout the globe that the West Coast refiners can buy from. LNG is becoming like that. So I don't think there's a real issue around depending upon imported LNG. If we were only depending on one or two sources of supply in the globe, then yeah, that would be an issue. But that's not where the market's going.
Well, and I think Frank really nails it here when he says, can we depend on imported food? I mean, it's the same kind of, it's a market to market thing. I mean, somebody wants to get paid. Brian asked a valid question, I think, on your first chart where you said it was adjusted for the kit, which is basically adjusted for the investment and build out in the import facility. And he says, doesn't that kit debt get retired? The answer is yes, but that's on a 20, 30-year window. What's the window for the kit to be amortized out over the course of what, a couple decades?
Yeah, it's probably a 30-year amortization, I would guess. And I mean, knowing how utilities do these things, And you have replacements. I mean, the kit doesn't, the framework doesn't go away, but the kit has to be, I mean, you have to put in new parts and new facilities and upgrades and that sort of stuff. So, I mean, there's sort of an ongoing capital cost associated with it. I mean, what Brian's suggesting is if the kit did amortize away and it was still there, then the price would come down because the cost of the import kit would come down. And so importing supplies would be even better for Alaska in that situation. But I mean, LNG facilities wear down, and so you've got to continually be reinvesting in them to keep them operating.
So it's a forever thing, is what you're saying. Maybe not at that rate, but it's a forever thing at some point. You don't have to replace them every 30 years, but you have to do, right, deferred maintenance, right? That Terry's like pointed out the deferred maintenance on it. Well, Brad, give me an over and under. If you had to make a prediction right now, what's your over under on it actually on phase 1 and phase 2 actually being done, or if you want to split them out?
I would say phase 2 is marginal. I would say phase 2 has a potential. I mean, more potential than I've thought before, because those construction costs that Glenfarne's now talking about are a lot lower than I thought what we were talking about before. So phase 2 has a potential, but it's not certain. And so given that risk of the phase 2 volumes, I think it's foolish for Alaska to enter into the phase 1 agreement, the fixed price agreement, and build a pipeline for just the phase 1 volumes. I think it's foolish to do that without knowing where phase 2 is going. So I think we condition phase 1 on phase 2, and we make the concessions that's been asked for the phase 2 price.
Brad Keithley, Alaskans for Sustainable Budgets, and the weekly top 3. We're on through number 2, which was a lot, but now we're into we were on through number 1, which is a lot. Now we're into number 2. What does the continuing lack of interest in ANWR? Been a hot minute since we heard about ANWR, but what does it mean for us? What does it spell? Does it spell prosperity or doom and gloom? Well, it's Brad, so we probably know where it's going. Shots fired. Brad, what do you say? What does the continuing lack of interest in ANWR tell you as a 30-plus year oil and gas consultant and attorney? What does it tell you?
So last week, in the middle of everything else about LNG, we had the opening of bids on ANWR. And in light of what happened in NPRA earlier this summer, can I say it's summer when it's only 45? Anyway, earlier this year in NPRA, in light of what happened in NPRA, I think there was some hope that the ANWR bids would come in, that we'd have some significant ANWR bids. NPRA attracted Shell, attracted Exxon. I mean, NPRA, the NPRA leasing sale was a big surprise in terms of the number of players that bid in for acreage in NPRA. And I think building on that, the hope was that we would see something of the same thing in the ANWR bids. We didn't. There were only 2 bidders in ANWR. One was the state, ADA, who bid for some more leases in ANWR. And the other was a couple of bids by John Hendricks's Hex, which Hendricks then followed up with this great press release about Hex, expands from the Cook Inlet and is now a North Slope player. Well, he bought a couple of leases in ANWR. That's what he did. Generally speaking, I think the reaction to the ANWR sale is another dud. I mean, there wasn't an Exxon, there wasn't a Shale, there wasn't an Anadarko, there wasn't any of the players that we've seen over on the eastern side, or on the western side rather. On the western side in NPRA, there's not any of the players that we'd seen over there come into ANWR. So why is that? Why did we have what I think most would characterize as a successful sale in NPRA? Why did we have such another dud on the ANWR side? And I think the answer is we haven't seen the type of results over on the eastern side of the slope, over next to ANWR, that we're seeing over in NPRA. I mean, over on the western side of the slope, we've seen Conoco's Willow project, we've seen Santos's Pica project, We've seen all sorts of additional developments out there. We saw the Biden administration approve the Willow project in NPRA. So we've seen the federal government give some approval to some activity, investment activity, development activity out in NPRA. So we've seen things over on the western side of the slope in terms of additional resource and additional development over on the west side of the slope, and federal approvals for that additional development over on the west side of the slope that gives some hope that maybe once, now that Conoco's established a beachhead with the Willow project on the west side of the slope, and now that we've seen some indication that there's a significant resource out in the west side, that people are going in and saying, and evaluating it and saying, look, that this looks like it's a good project and or a good area, and one that's developable, and so people are bidding on it. We've not seen that on the eastern side. The eastern side has had the Dami is probably a big development that people have followed over time. On the eastern side, that was sort of a very disappointing development. The oil bearing rocks were highly fractured, and so it was very difficult to find a significant volume of oil that was producible. Point Thompson has its own issues. It's a high pressure condensate reservoir, which is really very difficult to produce. That abuts ANWR, and so the concern is that maybe that's the sort of geology you see continuing into ANWR. There is some early exploration play on the eastern side, and maybe we will see something come out of that that will give people an indication that there is a resource on the eastern side that is developable. But right now, you're just not seeing as much promise on the eastern side, either in terms of the resource, the availability of resource, or in the ability to develop the eastern side in the same way the western side is being developed. So I think the answer to the question is, why is ANWR continuing to be a dud? I think the answer is the industry is really waiting on somebody to prove the hypothesis that there's something on the eastern side going after. We saw on the western side with Pikka and with Willow. We've seen on the western side that there is something going after, that majors are coming in, spending money, investing, that they're getting federal approval to make those investments. And I think on the western side, we're seeing that the people realize that, yeah, Alaska's back in terms of resource, and Alaska may be back in terms of the ability to develop that resource. And so we're gonna go focus on that. But in terms of the eastern side, we're not seeing a big resource development on the eastern side, a big resource opening on the eastern side that's convincing people that the resource is there. And we're not seeing any development in the eastern side beyond Point Thompson, which is not in the ANWR, which is on state lands. We're not seeing any development on the eastern side that gives people hope that they could actually develop, if they found something on the eastern side in ANWR, that they could develop it.
And of course, the big challenge with ANWR, and we had this discussion yesterday with Adam Crum, which was a very interesting discussion about, because he touted again Pikka and all the oil and all the money that was going to come from Pikka. And I pointed out to him that, again, higher production, lower taxation, lower income to the state. And they kind of waffled on it and everything else. But people, right? I mean, they're still saying, oh, look, Pikka's bringing in all this money. Pikka's bringing in all this oil. We're going to be rolling in dough again. And again, all this stuff that goes on in ANWR is going to be, not only is it a lower take because it's a federal money, on top of that, anything else they can do tax-wise, I mean, we're not going to be rolling in. They could build out the whole eastern side in ANWR, and we're still not going to see the money that we saw from the North Slope.
Yeah, under SB 21, as it has developed 10 years on, as it's gotten into its older age and developed the creeks and problems that happen when you get into an older age, as SB 21 has gotten into the older age, we're seeing all sorts of problems that have developed as a result of some of the bells and whistles that were not obvious at the time SB 21 was passed. And so, yeah, we do see. I mean, you have to look no further than the spring revenue forecast that Adam Crum's own Department of Revenue published. Yet you look no further than the spring revenue forecast that shows that as those additional volumes come on the eastern side, or on the western side rather, and elsewhere, as those additional volumes come on, revenues from production tax are going down, and revenues from royalties are staying flat because the new production is coming from federal lands, which doesn't have royalty to the state. So you're seeing a decline in revenues, an absolute decline. I mean, a drop in revenues from oil production going forward as a result of the bells and whistles, that the creaks that are coming out in SB 21 after the first 10 years. So it's Adam Crum is just, I mean, I don't think Adam ever understood his own department, much less anything else. I mean, I don't think he ever understood the revenue side of the state.
The look on his face when I talked about the governor's 10-year revenue forecast and how it showed that we were essentially broke was a little, I mean, he just, again, he's the commissioner of revenue that puts out these reports. And because I'm talking about a fiscal plan, and we can't really have a fiscal plan, and and all this kind of stuff. It's somebody just said it's pretty disheartening, and it is disheartening because, again, he went on to try and tout how SB 21 is the savior of us all, and all these other kind of stuff. I mean, I think the lobbying, he's been lobbied pretty hard. Let's put it that way. Into believing that.
Yeah, the talking points that he has, and other of these candidates are running around saying oil's going to save us. It's just stupid. I mean, you need to spend, all you need to do is spend like 15 minutes looking at the revenue forecasts that are coming, the spring and fall revenue forecasts that are coming out of the Department of Revenue, and you understand what's going on. You don't understand quite what's going on. You have to dig into it to understand what in SB 21 has gone wrong. And you have to spend some time going through that, which we've done. And I've got columns in the landmine that do that, but you have to spend some time doing that. But in terms of the top line, in terms of the revenue line, 15 minutes with the revenue forecast tells you all you need to know about where revenues are going, revenues from oil are going. The more, under SB 21, as it has creaked into its old age, the more exploration we have, the more exploration and new development we have, the lower the revenue. Not only the lower the percentage of take, but the absolute lower the revenue that's coming out of production tax. So it's a huge disappointment. Anyway, not only does that mean the western side is not going to save us, we're not even going to have the development on the eastern side that's even going to enter into that discussion, because the way it's going now, the eastern side is just not proving attractive to potential bidders. Michael, I very seldom read the comments that are going on on the right, but I just saw this one from Barbara Haney. Can you pull that up? Because I want to discuss that.
Well, good, because I was going to as soon as there you go.
Great minds think alike. All right. So Barbara says you would not have had any investment without SB 21, but you have to go back into the history to understand there was zero exploration at the time. Well, there wasn't zero exploration, but there wasn't a whole lot. And she's right on this point. SB 21 was good at the time because we were having very low exploration dollars in the state, and as opposed to globally, there was a lot of exploration going on, but Alaska wasn't getting its share of that. And SB 21 was a good step at the time to make Alaska attractive again. What's happened is that SB 21 has aged. The credits that SB 21 built in to attract producers have stacked on top of each other in a way that wasn't projected at the time it was developed. I mean, like any mechanism, like machinery or electronics or anything, any mechanism, there are unanticipated consequences. And one of the unanticipated consequences was the way the credits are stacking on top of each other. It's not what Barbara said in the case of zero or you have to go overly generous. The write-offs are overly generous. It's not so much that, although that's a contributing factor. It's that the way that the GVR, the gross value reduction credit, works, and the way it's sticking on top of, I mean, gross value reduction essentially says zero tax. We've talked about the effect on PICA. We've looked at charts on PICA and Willow and how it works. But the gross value reduction provision essentially says no tax, zero tax on new development, on any new development, zero tax for like 7 years on any new development. And so it's that provision sitting on top of all the other provisions, all the other credits. Oh, and GVR also says that you're not subject to the tax floor. You're not subject to the 4% minimum gross proceeds tax. So you can go below the 4%. Essentially, what that means is Repsol and Santos are paying zero tax for the first 7 years of your development. And as you continue to see that develop, as you go out west, I mean, it has this sort of continuing effect on driving production revenues down. So it's that provision, not foreseen, because at the time we did SB 21, we thought, about 3% of the volumes are going to come from GVR. Now we're projecting over the next decade, the revenue forecast is projecting we're going up to like 40 to 50%.
Right.
Of the volumes are coming from GVR.
It's the unintended consequences. You're not saying, you're agreeing that SB 21 did good things when the investment was low or there was disinvestment. That it did some good things there, but it was the unintended consequences that you couldn't foresee 10 years down the road that's now rearing its ugly head. And that's why these things should never be set in stone, because there are unintended consequences and unforeseen circumstances and kind of that perfect storm of all the things coming. That's why we need to be able to revisit these different tax rolls and these things, because otherwise, we could just get rooked, or it could go the other way, and the oil companies could get rooked. Right? That was the back in the late 70s, early 80s, when they had, I can't remember what the name of the tax structure was, but it was, they were down into the $8 range for oil or whatever. And they're like, we can't continue this, and so they had to make those changes.
Well, that's where SB 21 came from. SB 21 came from the fact that ACEs, the Sarah Palin era ACEs, way overtook in terms of the revenues from the oil companies, and was a disincentive to the oil companies to invest. So SB 21 was an effort. SB 21, which was 2013, 2014, we hadn't looked. So 2013, 2014, following on ACES, which was 2007. So 7 years later, the oil companies were screaming about, the fact that that the Alaska tax structure had gone out of date. And so we came back in with SB 21 and fixed the problems that ACES had created. I've never done in the industry, my entire time in the industry, I never did a contract that didn't have reopeners at some point. And about the longest those contracts would ever go in terms of reopeners is 10 years.
Right.
And so now SB 21 was in 2013, 2014. We're now, 10 or 12, 13 years down the road from when we did SB 21. It's time to go back in and look at that thing.
Yeah, no, and I would agree. Again, I'm a fan of the oil companies. I like what they do. I like that, to have Alaskans open for business, et cetera, but it can't be universally. These people who are like, you can't do anything to them. They're our bread and butter. No, they're only 20% now. They're not necessarily the bread and butter that they used to be. When they were providing 50, 60%, that's one thing. But here we are today. Brad Keithley, Alaskans for Sustainable Budgets, the weekly top 3. We're down to number 3, the final one for today. Most candidates seem oblivious to the signals that Alaska consumers are sending. And I know why. I could give it to you in the short form is this: because there's no connectivity between the government and the private economy. That's pretty much it. But most candidates seem oblivious to it. Brad, what are your thoughts on it?
Well, there's a couple of headlines, a couple of articles this past week that Rob Myers, frankly, sent to me that I think are they're giving you a signal. They should be giving those who are reading the news, keeping up with the news, a signal that the economy isn't the Alaska economy. Down in the bowels of the Alaska economy isn't doing very well. One was Alaska is one of only 2 states to see an increase in SNAP participants in 2025. Alaskans, the federal government went through a bunch of Trump administration went through a bunch of reform. I think the One Big Beautiful Act has a bunch of provisions that really tighten the screws on SNAP SNAP participation, SNAP
Benefits.
approvals. Yeah, thank you. SNAP benefits. And so you've seen most states have a reduction in SNAP benefits, SNAP participants over the past few years as a result of the act. But Alaska and Hawaii are two states that have seen an increase in SNAP participants. What that tells me is that the economics of the Alaska economy, when you get down into lower middle and lower income brackets, is not doing very well. That we have more people applying for SNAP, more people qualifying for SNAP than we did even before. The second one is out of the Anchorage Daily News. The headline is Alaskans are increasingly falling short on debt payments, state report says. And it's talking again about the creditworthiness of Alaskans and the fact that they're falling further and further behind, particularly on credit card debt, but also on other categories of debt. And another indication that things are not going very well down in the bowels of the Alaska economy. There's something about the Alaska economy that I try to focus on once a month in a Sunday chart. There's something about the Alaska economy that's important to understand. When you look at the Alaska economy on average, and the Alaska consumers on average, it's looking like it's reasonably well. It's not setting any whirlwind records among the states in terms of its strength, but it's looking reasonably well. But when you spend time in the census data and you try to understand what's going on by income bracket, you see a huge divide. And what's going on is the upper income brackets are doing well, indeed, probably doing better than they've done before. When you look at the income tax data, there's the upper income brackets are growing in terms of income, but the middle and lower income brackets are falling further and further behind. So on average, when you average in what's going on in the upper income brackets with what's going on in the middle and lower income brackets, Alaska's looking okay. But when you break it out and start looking at it by income bracket, you begin to see a real divide in the data. And I think what these headlines are telling you is that when down in the bowels of the Alaska economy, in the middle and lower income brackets, Alaskans are increasingly falling short on debt payments. There's an increase in demand for SNAP authorizations. And you're seeing the effects of what's going on in the middle and lower income brackets become more and more obvious with programs like this or with issues like this developing. I think there's a great opportunity, but you don't hear candidates talking about that at all, really. I think there's a great opportunity for candidates to start talking about middle and lower income Alaska families need a tax break. I mean, PFD cuts are a tax, right? We've been through this for an infinite.
We even got Adam Crum to agree to that yesterday. I mean, he agreed to that.
All right, so PFD cuts are a tax, and it's a hugely regressive tax that hits middle and lower income Alaska families a lot harder than it does upper income families. It barely touches upper income families in terms of the share of income. So PFD cuts are a tax. Alaskans need a tax break. Middle income Alaska families need a tax break. The last numbers, I think I have it here. The last numbers I did, no, I don't have it here. The last numbers I did, oh, there it is. The last numbers I did showed that lower quartile in terms of the impact of PFD cuts, PFD taxes on those in the lower quartile incomes is 20% of their income is being taxed. Potential income is being taxed through PFD cuts. 7% in the lower middle quartile, 4% in the upper middle quartile, only 1% in the upper quartile. And by the time you get out to the top 5%, it's zero, effectively zero, because it's so small as not even to get to the 1% figure. And so you have a huge tax that are hitting middle and lower income Alaska families. You see these sorts of headlines that talk about the impact of these of what's going on economically with middle and lower income Alaska families. And so I think there's a huge potential to talk about. We need tax reform. We need tax breaks for middle income families that are being affected by 4 to 7% government take from their incomes, compared to 2% on a flat tax, compared to even less than that because you shove so much of the burden off on non-residents, or you push so much of the burden off on tourists and other non-residents. Even less than that, even less than the 2% with the sales tax. Alaskans need tax reform. Middle and lower income Alaskans need tax reform at a rate that's not particularly burdensome to up if you use sales taxes,
right.
Not particularly burdensome to the upper income. I think there's a huge opportunity. I mean, we've seen the appeal of middle income families need tax relief. We've seen the appeal of that argument in other states. We've seen the appeal of it at a national level. There's an opportunity to make that argument in Alaska. And I'm surprised that no candidates, particularly when you see headlines like this that give you an indication of what's going on with the middle economically, with middle and lower income brackets, particularly when you see those sorts of headlines. I'm just surprised there's no candidate picking up on that and talking about the need for tax cuts for middle income Alaska families.
Well, some people would argue that it's a feature, not a bug, that this working as intended, because now they're creating that dependency state that we were talking about. And look at it. I mean, we got the Medicaid thing where, 1/3 of Alaskans, 1/3 to nearly a half of Alaskans are on Medicaid in one form or another. We've got the SNAP benefits. We've got all this other stuff. We're creating the dependency state. And I think some people like that. They want you to depend on government, and others are just going along for the ride because they're so tax averse that they can't, and they don't consider the PFD cut a tax, the Randys of the world, that they'll do anything to avoid it, even if it means growing the government.
Yeah, it's a death spiral though, right? I mean, so what you do is you say, okay, we got these government programs. They are taking care of middle and lower income Alaska families. So the solution is to grow those programs to make sure that they fully take care of middle and lower income Alaska families. Well, guess what the revenue source is for growing those programs? It's more PFD cuts.
Right.
So it's a death spiral. You're making them worse off by taking more income out of their pockets to give a share of them, some select share of them, a program that costs more and then takes more out of their pockets. It's a death spiral. We need a candidate who starts talking about a growth spiral. Tax cuts that result in growth by increasing income to middle and lower income Alaska families, reduce the dependency, increase the amount in their pockets to be able to spend in the local economy, which they do, and is a growth spiral in terms of lifting them out of the economic situation they're in, making them better off, reducing the need for government programs, and making the local economy better because we've got more money in their pockets.
This is the biggest problem right here. Higher PFDs could reduce the pull on programs, but we'll need to ditch the hold harmless provisions to see the full benefits. Yeah. I mean, I agree with this, but like I said, don't think that this is not just working as intended, that this isn't, that this is some kind of bug. This, in some people's minds, is exactly what they want. They want that dependency because, again, it gives them the power and justifies the power that they're taking by being able to spend all this money.
Well, Zach Fields, I guess, looks at it as we need more government employees, so we need more government union members, and so that's more dues, and so that's more support for Zach's daytime job, which is being a union employee, or Wilikowski's. I mean, yeah, I understand that, but in terms of the gubernatorial candidates, in terms of them focusing on the Alaska economy and focusing on outmigration, I mean, this plays a role in outmigration, right? You hit middle and lower income Alaska families hardest. If you look at the income tax data, they're the ones leaving. They're the ones that are outmigrating. Top 20%, top quartile they're happy. I mean, they're staying, they're growing in number, but the middle and lower income Alaska families are the ones that are leaving. So it plays into so many issues that are economically affecting the state. I'm just surprised that there's not a candidate who's picked up on it, particularly on the two sides, Shelley Hughes and JKT, both of whom were on the fiscal policy working group in 2021, 2023, 2021, whatever year it was. Both of whom were on the fiscal policy working group, and both of whom went into this issue in depth and understood the issue and came up with a proposed plan that they've now since abandoned that they're running for governor.
Right. And we pinged that off Crum yesterday, and he just kind of deflected it. I mean, there's some good things, but it just kind of deflected the whole thing. Wouldn't commit to doing anything on it, and everything else. So it's again, working as intended. Rob just said, we wonder why working age people are leaving the state. You and I have been talking about why working age people are leaving the state, and it's because they're getting taxed on their PFD, and there is no connection between the private economy doing well and the government doing well. And that's the problem. Without activity, it's going to continue to grow unchecked.
Yeah, and let's look at what the PFD is. The PFD is the equivalent, the Alaska equivalent of royalty payments to landowners in the lower 48. In Oklahoma, Texas, Louisiana, Arkansas, New Mexico, Colorado, just pick a producing state, West Virginia. In those states, landowners get royalty payments direct into their pockets. That increases their ability. The fields are widespread. You got a lot of people who are benefiting from it. And so you get people who have economic strength, economic ability, who grow the local economies, make the contributions, make the purchases in the local economy and grow the local economies. You have a growth spiral that go on in those states. The equivalent payment that's going on in Alaska, the PFD, which is the equivalent of the royalty payment in the lower 48, you have a death spiral going on because government's increasingly taxing it to pay for increasing government dependency programs that then are growing because you have people whose economic situation is declining because we're taxing their royalty payments. And we have an increased growing government dependency, which requires additional government spending, which reduces their royalty payments even more. You have a death spiral going on. You would think some candidate would be out there going, I want to talk about a growth spiral. I want to talk about making the Alaska economy stronger. And we can do it in a way that restructures taxes, pushes a significant share of the burden off on non-residents, spreads the burden out much more broadly than it is right now, being focused on middle and lower Alaska families, and like occurs in Oklahoma and Texas and West Virginia and New Mexico and other producing states, results in a growth spiral. You would think there's a candidate out there that wants to talk about a growth spiral, but no, they just they're not thinking about this. Either they're too afraid of taking on the top 20% who are essentially paying no taxes now. They're too afraid of that, or they're not sharp enough to understand how you create a growth cycle.
Brad Keithley, Alaskans for Sustainable Budgets. One final question. Rick says, so Brad, what happens with no gas line? Coal, then electric appliance, lots of coal here. Can we use coal and create gas? I mean, I know now we're grasping at straws, but that's really the $1 million question, is it not?
No, LNG imports. LNG imports are cheaper than, there may be people who want to argue with me about coal, but LNG imports are cheaper than any of those alternatives. And there's a lot of LNG out there in the world. So I think that's where we go with no gas line for South Central.
All right. Brad Keithley, Alaskans for Sustainable Budgets. Thank you so much for coming on board. Are you liking any of the candidates, Brad, or are they all just looking poorly right now?
I want to like Shelley. I want to like JKT because of their service on the fiscal policy working group, but they're just making it impossible with their discussion of revenue and government spending. I mean, JKT wants to spend more on every government program that's out there. Shelley somehow thinks magically if we make the economy better.
Are muted.
Yeah, sorry about that. Go ahead. JKT wants
to. JKT wants to spend more on every government program. He's not talking about the good economics, growth economics.
Right.
Shelley out there is talking about, resource development, but we've already talked about resource development under SB 21. It keeps on going down in terms of revenues. So they're not talking about the right things. And so I want to be supportive of those, but they're making it impossible.
All right. Brad Keithley, Alaskans for Sustainable Budgets. Thank you so much, my friend. We'll talk to you again next week.
As always, Michael, thanks for having me. Well, that's a wrap for another week's edition of the weekly top 3 from Alaskans for Sustainable Budgets. Thank you again for joining us. Remember that you can find past episodes on our YouTube, SoundCloud, Spotify, and Substack pages, and keep track of us during the week on Facebook and Twitter. This has been Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. We look forward to you joining us again next week for the next edition of the Weekly Top 3.